If everybody wants to settle in, I'm going to do some brief introductions. If you haven't already, this QR code links to a little survey that we have that puts you in the running for a raffle. And the ladies will tell you afterwards what that raffle is. We're going to draw it as we're going through everything. But we're trying to get into the 22nd century over here and do it through the QR instead of on paper. So if y'all have an opportunity to do that, please do. We're going to run through slides after y'all get all this finished. But I'm Trevor Morton. Thank you so much for coming today. I know it was a little bit hazardous on the roads. I drifted most of the way here myself. And cool weather. We don't know when it's going to end, but I'll take it for a couple more weeks. We are the Cachet team. We've got 126 years of lending experience, and we wanted to give back to the community, and that's why we're doing these Cachet presentations. Today, we've got a couple more people here, and I'd like to introduce them. If you don't already know them, just give them a wave or say hello. We're going to start out with Coral. She handles business development for us over here. Jackie, who's one of our best and most knowledgeable loan officers. Brian, also in the business for, what are we at now, Brian? 22 years. Aaron Cap over here, he's also a loan officer for us, and I think everybody else is still working. Oh, Ashley's not working, she's here. I couldn't see you over there. But thank you again for showing up, and I'd like to introduce a man that I have done numerous radio shows with. We do a heck of a lot of business with, and he's the one that actually provided all our food today. So Abel, you want to come take the stage, my man?
Hello, everybody. How y'all doing? My name is Abel Longoria. I'm with Mojo Insurance. I'm not going to take up too much time. We're here to see more of the financial stuff. But yes, I help out pretty much all of their deals. If you guys are assuming the Cachet team insurance or for loans, there's a good chance I'm going to be doing the quote on the insurance side. I provide every client with 3 quotes, the cheapest thing we can find, the cheapest thing with all the water coverages, and then one with all the water coverages and the low deductible. We kind of feel like that just kind of hits all the options for everybody. They don't have to go shop. We shop with about 45 different companies for them. Also for realtors, if you guys are realtors, you can call me and I will give you claims reports. So if you have any sort of client who's maybe on the fence with the house or they just need a little bit more information, call me. I can look and make sure that there haven't been anything crazy that's happened in the past 5 years or just to check in. So I'll pass my card around. That's pretty much it. Happy to help any clients with any questions, anything that you need, just let me know.
Thank you, Rick.
All right, thank you.
That man right there knows his stuff, and that's why we use him. Great people.
Thank you, sir.
Little update on this series and other stuff we have coming up. We've got a fun event coming up on March 11th. We're actually doing a crawfish boil here in the parking lot. It's going to be Friday, March 11th, and it's just to come, hang out, eat a bunch of mud bugs, have a great time. Inside, March 11th. And everybody, if you fill this out, you're going to go on the list that goes for all the events that we have coming up, so you make sure to see it. And then Wednesday, March 30th, we have another feature on the educational series talking about real estate development and investment, and that's going to be taught by Miss Evelyn Ramirez. So make sure you're here for that one. It's going to be interesting. So the man that needs no introduction, the main show, the financial savant. Robert, come on up here and introduce yourself, buddy. Give him a round of applause, guys.
I do need an introduction, but thank y'all for having me. So my name is Robert Armendariz. I'm a financial services professional at Life Securities. And really today, one thing it's tax season, so I've been getting a lot of questions from clients on what to do. But one concept I like teaching kind of makes finances very unintimidating. Every time I talk to someone who really starts from the ground up or has already kind of made good amount of money, but they're kind of lost on what to do, I really like to show this concept because it really makes it very, very simple to understand what you should be doing financially. Does that make sense? So the handouts, the financial house, I printed those out. So Coral printed them out, but If y'all want to fill those in for your notes, I like it to be very interactive. If y'all have questions, please ask questions. If y'all have anything, learn from experience, please feel free. I love, really having audience participation when I do, anything. So really, so on the financial house. And if y'all have, if y'all want to, on anything I'm on, if y'all want to say anything, feel free to. But what would y'all say is the first part when it comes to building a house? Not everyone at once.
Foundation.
Foundation. Why? Why?
So it can stay up.
Got something to build on.
Got something to build on is the base. All right. So your foundation is going to consist of 3 parts. And I'll get more into detail on why. The first one is going to be your life insurance, your health insurance, and then your long-term care, disability, replacement income. Okay. Next, you're going to have this little sliver right here. And this is your emergency fund. Okay. So we always recommend you want to have anywhere from 6 to 9 months of funds inside of this account. So if your monthly bills are, let's say, 4,000, multiply that by 6, that's how much you want to have inside of this account. The only time you add money to this account is for inflation. So like right now, inflation was crazy, 7%, you want to add 7% more inside this account. But this is not money that's invested, okay? You know that if you have 25,000 in that account, you know that 25,000 is going to be there next week, next month, et cetera, et cetera. Does that make sense? This is for that check engine light type days that we all have. After that, you're going to have this big part. And this right here is your wealth accumulation, okay? And your wealth accumulation is all about, your 401ks, IRAs, investment funds, accounts, real estate, things like that. Things that you're building for your future. That makes sense because that's all on you. Now, after that, and yes, it's after, and I'll explain why, you're going to have your education funds. Okay, and this is for college, et cetera, et cetera. Now, I do get a lot of clients who say, my kids come first. Well, here, they don't. The reason why is because there's many options to pay for education, right? You got loans. Me, I got academic and baseball scholarship. There's many ways you can actually pay for college. But what's going to happen if you go to a bank and you ask for a $2 million loan to retire? Probably going to laugh at you, right? So you really want to make sure you're starting on that wealth accumulation before, because there's many options to pay for education. And now it's becoming more and more popular to go to trade school. There's really different options. It's not really, hey, let's go to a 4-year education anymore. The world's kind of shifting into different ideas. After all this is built, you're going to have your roof. And this is for that speculative investments. Okay, so speculative investments are anything you kind of feel is a risk, right? So back in 2020 when COVID happened, everyone was an investment genius, everyone was a stock genius, right? But what's happening now? The whole Russia-Ukraine situation that's happening, obviously we have rates going up, et cetera, et cetera. All that is causing the market to crash. I mean, if y'all look at the Dow Jones, right now it's going down. What happened to everybody who was investment genius? That makes sense? It's easy to win when you're winning, but when you start losing, that's when the financial house starts messing up, because most people have this part at the bottom. And what happens when you don't have a strong foundation? Everything comes crashing down. Now, this is for me, and I will say that this was my idea. You do want to have a chimney, a little smoke coming up. This is your crypto for everybody who's right? Because crypto isn't, so every 20 years, there's always something new, right? 20 years ago, we had the internet, right? It caused the whole Y2K situation. Everybody thought that was crazy, but it happened. So now everybody says, is crypto the new internet? Could be. And as a financial professional, we always recommend, if y'all want to write this down, 2 to 5% of your net worth, excluding your house, should be in crypto. The reason why is because I can send you a lot of articles from very, very smart people, smarter than me, who will say crypto is the next big thing. However, I can also send you articles from very, very smart people who tell you crypto is a bust, right? But that same ratio happened back in the 90s when people were talking about the internet. So again, 2 to 5%. Why? Because if you lose 2 to 5%, is your life really going to change? No. But if it is taking off, then obviously you're part of the game and you don't have FOMO, as they call it, right? Let's go back into the house. So for those who has kids here, about 50% of the room. Okay, so what were to happen if you don't have life insurance and the main breadwinner, God forbid something happens to him, what happens to the financial house? Comes crashing down. Because now it's considered what? An emergency. Okay, so that's why this is one portion of the foundation. Let's go to health. So I'll use me for an example. I had heart surgery when I was 11. If it wasn't for my dad's health insurance and he didn't have that, what would have happened to the financial house? Would have come caving in. Because now it's an emergency. That makes sense? Long-term care disability, that's more replacing income in the situation to people in their 20s. 30% of them have a long-term care or disability situation to where they don't have income coming in. And that's in your 20s. The statistics just get higher and higher as we get older. Hey, what's going on?
My dad's a State Farm agent. He sells long-term care. He said for my whole life, like that's the most valuable thing you can get because you get having to step to pay for something in the future. It's like people get hosed all the time. It's usually really cheap when you start early.
So long-term, it's actually, it gets harder as you get older to get approved for long-term care. Long-term care, I always tell clients, it's using 1% of your net worth to protect your other 99. And I've seen it happen. It is the number, in a long-term care situation, that is the #1 drainer of all your wealth accumulation. That makes sense? That is the one thing that I've seen people sell their properties. I've seen people how to liquidate 401ks after paying taxes and penalties, all that good stuff. So again, and I personally don't think it's talked about enough. I think it should be, but it gets a lot more difficult to get approved. It's a lot harder to get approved for long-term care than it is for life insurance or health insurance. So thank you for that. But any other questions about like the wealth accumulation, taxes, anything like that? I'll like to go more into detail on anything else. Yes, sir.
As far as the life insurance, could you go a little to the details?
Well, I'll talk. Do y'all know the differences between life insurances? Yes, no, a little bit. Okay, I'll explain. So essentially, there's two main types. And the way I like to explain, can I use that board? Can y'all see that board? Okay. So the two main types, and I'll use this bottom half. So there's two main types. One is like renting, and one is like owning. Okay. On the renting side, you can basically rent a policy for, let's say, 10 years, right? And all it's going to cover is life insurance, and that's it. That makes sense. It has a roof over your head, kind of like an apartment. The only issue is there's a lease. And what usually happens when the lease is up and you want to renew, it's going to be more expensive, right? So the way a term, and more, the better way to call it is a term policy, is you're going to be paying the exact same thing for 10 years. At the end of the 10 years, you're 10 years older. You never know if something happened to you within those 10 years. So if you want to renew it, it's going to get a little bit more pricier for another 10 years. Does that make sense? These aren't bad. Every time I explain this, why would I do that? Because right now I have a lot of friends in their early 20s buying a house, et cetera, et cetera. So there's a budget, right? So what's good is taking out a term, let's say for 20 years, to cover the mortgage, especially if you're the main breadwinner, right? So you can get a lot of term for very little. I've seen policies for $1 million for $30, $35, right? So $35 just to cover the house. If it happens to you, I kind of see that's a big deal. As you get older, more money comes in, then you go ahead and change. This right here, there's many different types. You've heard of a whole lot of VUL, IUL, things like that. This is just like owning a house. It's going to build equity. So inside the account, you're going to have value that you can borrow against, take out, do whatever you want. A lot of wealthier people who can't really do any Roth-like vehicles like to use these types of accounts so they can build up tax-free accumulation of money that they can borrow against, use, et cetera, et cetera. It also creditor protected. So you're a business owner, and as business owners, a lot of people try to come after you. So any creditor that tries to come after you, they can't touch any money that's inside of an equity building policy. Okay, so there's a little bit more pricier just because it has more bells and whistles, but it's the same comparison as to renting and buying a home, right? A home is going to be more pricier, but the reason why is because now you're building your own equity inside of that property. It's the exact same concept, right? So I'm not saying one is better than the other. I'm just saying that it really depends on the situation. The thing I do recommend for most people is to get as much as you can when you're young, because most companies will let you convert it. That makes sense? So let's say you take it out at 25 and God forbid at 30 something happens to you. Me, I mean, when I got my life insurance policy, I couldn't get the best rating because, like I said, I had heart surgery, so that was in my history. But God forbid something happens to you within these 10 years, you are just approved for the insurance policy, so you can go ahead and convert it whenever you like for something more permanent. That makes sense. So any questions on that? Hopefully I explained that.
Is there any difference on tax advantages to either of those on when you actually do pass, that one will be better than the other? Or are they?
Oh, it's all tax free. It's all tax free. Yeah, it's all tax free. So that's why people use this as a Roth-like vehicle. Higher income people can't qualify for like a Roth, which is a tax-free way of accumulating money. They usually just have money if they get approved. But that cover that? Awesome. Any other questions y'all have that y'all want me to cover on this? I'm going to go into another topic. But we good? Sweet. Can I erase this? Did everybody write this down? Awesome. All right. So one question I'm getting right now is taxes. So obviously we're in tax season. And I've noticed that a lot of CPAs, they always tell you what to do. They don't tell you where to go. That makes sense. They always say you should do this. Then you're like, oh, where do I do that? Most people go to a bank, which is fine. But I really like to talk about this concept. If y'all want to flip the paper over, this is really easy to draw. But I like talking about the 3 different places that money goes. Okay. So the first one is tax now. So this is money you already pay taxes on. Okay, so this is going to be money that's in your checking and your savings. This is money that you have in mutual funds, brokerage accounts, CDs, things like that. Things that's already been taxed. All right, you pay it at today's rate, and then you don't have to really worry about those taxes anymore. Then you have the middle account where majority of people have their money, and this is your tax later. This is money you can deduct today, but I always tell people deductions have to be done in a very, very smart way because there is no point in spending $1 to save 20 cents. Does that make sense? No pun intended. So your tax later buckets are going to be, the most common one is your 401k, your traditional IRAs, and then teachers and nonprofits like 403bs, things like that. So this is money you can deduct today, which is where most people are going to do. The only issue is the government has a lien on this money. And what I mean by that is you will have to pay tomorrow's tax bracket, whatever they are. So with the show of hands, who thinks taxes are going up? Right? So that just means you're going to be paying those tax brackets whenever you decide to take this money out. Right? So I had a gentleman I was talking to had a good amount in his 401k, and I told him, you're only keeping about 70% of that. He did not know that because 30% of that is going to be paid to Uncle Sam because he decided to pay them later. That makes sense? And then you're going to have this bracket, which is tax never. There's only 2 main types. You're going to have your cash value life insurance, which is what I explained over there, and your Roth IRAs. The only issue with these 2 is you do got to qualify for both of them. This one health-wise, this one income-wise. Y'all know the income levels for Roth IRAs? Okay, so Roth IRA, if you make more than 140 and you file single, you can't do a Roth IRA. You're going to have to fade out, right? So the government doesn't allow you to do that. If you're married, if you file married and you make more than 208, then you can't do a Roth IRA. Does that make sense? You're going to begin to phase out. Phase out just means the government's basically going to tell you got to put less and less and less inside of a Roth. All right. Now, what we've seen in the past 15, 20 years is majority of people have their money set up like this. They have 20% here and they have about 80% here. Okay. Most of the time it's just because they don't know where else to put it. And what's happening is people have liquidated 401ks, IRAs, things like that a lot faster, and they ran out of money in their retirement years a lot faster for a lot of risks, but the main risks is tax risk, right? So basically, in one example I'll show is, let's say when you decide to retire, you want to take out $100,000 from your 401k, well, you're gonna have to pay taxes when you take that out because you decided to pay those later. So let's just keep that simple. You take out 25,000, well, you pay 25 to Uncle Sam, you're left with 75K. That makes sense? But what a lot of financial professionals have recommended within the past 20 years is making sure you have a combination of these two buckets. So instead of putting 80% here, you put 40% here and 40% here. Have you noticed the numbers still equal 100? We didn't change anything. It's still $100. So all you're doing is repositioning monies. The reason why is instead of doing this example, let's say when you retire, you take out 50K. Well, because you took out 50K, you're in a lower tax bracket. Let's just say instead of 25, you're paying 15%, which is 75. Please correct me if I'm wrong. You're left with 42,500, correct? But now you have money here that's already been taxed, and you don't got to worry about it anymore. So let's just say you want to take out 50K from here. You add 50K. You're left with 92,500. What would y'all rather have, the 92 or the 75? Does that make sense? So this is one big thing I like to tell people is it's really, really good to get deductions, but make sure they're very smart. Because getting deductions is one thing. It helps you today, but it's your subscription to live in the US. You got to pay it eventually. You know what I mean? So any questions on this? Yes, sir.
So when you're pulling from the never category, is that borrowing against it, or are you actually doing the withdrawal?
Depends on how you want to take it out. Yeah, some people withdraw, some people borrow against it. Really just.
Are there any penalties on the withdrawal of it?
On a Roth, most of the times, because it is considered a qualified account, you will have to pay probably a 10% penalty on the gains. But the thing about the Roth is most of the time you can set your cost basis, which is what you put in, right? But like on a VUL, what Aaron was talking about, which is basically, it's like the whole life I was talking about over there, the equity side, but a portion of what you're putting in is actually getting invested into the market. That I always recommend borrow against is the best way, because the only collateral you have is your death benefit. So if you borrow 100,000, you got $1 million policy, something happens, then your beneficiary only get 900K. I'm sure they'll be all right. You know what I mean? But any other questions? Anything else I can cover that y'all are curious about? These are the main topics I wanted to cover today, just because of tax season and the basics of financials. But anything else? Hopefully I answered everybody's questions. Yes, sir.
These are all products you offer?
Some of them, I mean, I don't offer health. I don't offer health insurance, and then obviously your emergency fund, I can slap you on the back of the hand and say no. But yeah, which I have done for some people where friends will call me and be like, "Hey, is this smart?" I'm like, "You want me to be your friend or your financial advisor?" As a friend, that's awesome, but as your financial advisor, no. But majority of the time, yeah, it just depends on the certain type of. It also depends on what type of work you're in. Are you a 1099 or a W-2? Right, that really depends. Who here is a 1099? Okay, so for example, on a 1099, a lot of what's recommended in this bucket is a SEP IRA, self-employed pension. The reason why is because you can put 55,000 or 25% of your income, whichever one is less, right? But again, you got to make sure that it's a smart move, because you do not want to spend $1 to save 20 cents. Is what a lot of people do, like out in West Texas, where I'm from. They'll go buy a brand new truck because they want a deduction. It's like, dude, you use a lot of depreciating asset just to save you 20% on taxes. You know what I mean? But also it's because they don't know where would be the best way to put their money. So W-2s is a little tough. What I do recommend for W-2s is just shifting money. Majority of people say I'm throwing everything in my 401k. If they offer a Roth or you want to do a Roth, I mean, that's something I do, but I recommend, hey, if they match you, so if you are a W-2, let's go into 401ks a little bit. On a 401k, the only time I recommend to do it is if they match you. So if you put in 5% and they give you 5%, sweet, that's a good deal because that's free money. The reason you don't want to overdo that is because all you're doing is you're putting more money in this bucket, and we all just agree taxes are going up. So you're basically giving Uncle Sam a bigger pile of money that they can take a bigger portion from. Does that make sense? So I've seen it a lot where they say, I do 10% of my 401k, how much do they match? 5. It's like that 5 difference, pay 1% to Uncle Sam and move that forward to this bucket. That makes sense? You really don't see any difference in your paycheck. You're already used to that money going somewhere, but now you're diversifying your taxes. You don't have to pay so much. So that's it.
What's your stance on your tax liability being taken out of every paycheck?
I recommend to do more because I'd rather give money more at the end of the year, not to owe. but you also don't it really just depends on the situation, because I personally don't have kids. So I would like, hey, take more, I'll just get more at the end of the year. But if you do have kids, I mean, I would get with the CPA to figure out what would be the right way. But I always would rather get money more at the end of the year back to me than having to pay a percent at the end of the year. Because it's always a surprise. And let's be honest, who really, really, be honest with yourself, saves money to save? Let's just be honest. Recommended where you can at least break even at the end of the year. Because I have seen a lot of clients where it does mess up the beginning of the year when they realize, oh, I have a $5,000 tax bill I gotta pay. Does that make sense?
I have a question. So speaking on that term of like the taxes and that kind of stuff, I have heard that if you take as like zero reductions and have them take out max.
Mhm.
Well, hold on.
Take zero deductions.
And put it into a Roth IRA, then you don't pay as much taxes on it at the end of the year.
On the Roth IRA,
You save in taxes if you don't pay in percent.
You'll only get the inflation. So you're given basically a tax-free interest rate to the government. You know, like if you have all the money go to the government and you get a big check back, then they have that money interest-free. But you don't get a tax deduction on a Roth IRA.
no, you don't. Are you asking? Yeah, no, on a
Yeah.
Roth. So anything here, you don't get a deduction
Yeah.
on. So Roth IRAs, a lot of that's actually a good question. Let me cover that because that's a huge confusion people have. Is I do get it at least once a month where people say I put money in a Roth and we deduct that, and I'm like, oh, who does that? Who did that? Who's telling you to do that? Because you cannot deduct what you put inside a Roth IRA. Does that make sense? I see a Roth IRA as a forced savings account that you cannot deduct. A traditional you can. All right, that's probably where the confusion comes from. But no, anything that's Roth, you cannot deduct at the end of the year because it's considered money you already pay taxes on. That makes sense. A deduction is basically you're telling the government, I made less than what you think I made. So in a 401k, they just increased it. It was 19,500. It's now 20,500. And you make 100,000 and you max out your 401k. You basically are telling the government, hey, I actually did it because I put that into a tax later. But because it's in a tax later, when you decide to take it out, that's when you get taxed. So it really just depends on if you want to pay taxes now and you can control it, or if you just want to say, I'll just pay them later. But we just can't control what later is going to look like. And I'm in the same boat, but I think they're going to bust. We printed about 22% of the money we have right now in America was printed in the past 2 years. So that's a lot. Wow. Yeah. So that's why stocks are overinflated right now, because people really didn't need a stimulus check. We got some, and what did? They opened up a Robinhood, and what's the problem? We all need the Robinhood. So, any other questions? Yes, ma'am.
Where in your opinion does real estate fall into that category? Because you are technically paying taxes
So-
every year, but then it's an investment for later. So where in your opinion does it fall?
So real estate, so I really like real estate when it comes to two things. You can leverage a lot of money, right? And for the write-offs. So there's a lot of deductions you can do with real estate. The only thing I've seen that clients have told me is you just can't go eat the brick if you're hungry. Does that make sense? So you got to do it in a smart way, because most people say, "Why just put everything in real estate?" So I would do. What happens if you need the liquid money right away? So I think real estate's a great way to leverage a lot of money and to get really good tax breaks, but it really has to make sense inside of your financial plan. And that's the one thing I tell people all the time is never compare yourself to someone else's financial plan, because you're a completely different person with a completely different financial situation. I got friends with 2 kids who ask me, what should I do? It's like, you do not want to do what I do. We need to put together a plan for you. But I think real estate's a great way to get those deductions, especially for higher income individuals. So I never knock real estate. I never knock the stock market. I never say one's better than the other. Just really depends on what your financial goals are for the future, and obviously what your tax situation is. Did I cover everything? You know, that y'all can really think of? I hope I did. I'm very passionate about financial literacy for personal reasons, so I really like to cover as much as I possibly can, but. Sweet. Any other questions? Anything I can answer? No? But thank y'all for your time. Hopefully I brought some type of
Yeah.
value. But I'll be here for the next half an hour if y'all have any questions. If